Well, good morning, everyone. I'm Vanda Vickers. I'm the Chief Operating Officer at Global Risk Institute, and I'm delighted to welcome you to today's webinar, The New Macroeconomic Paradigm, Pandemic Lessons, and Policy Needs. Although this event is virtual and many of you are joining us from across Canada, I'd like to open the webinar with a formal statement recognizing the unique and enduring relationship that exists between Indigenous people and their traditional territories. I'd like to also acknowledge that the Global Risk Institute is headquartered in Toronto, which is situated on the traditional territory of many First Nations, including the Mississaugas of the Credit, the Anishinaabeg, the Chippewa, the Haudenosaunee, and the Wendat people, and is now home to many diverse First Nations, Inuit, and Métis peoples. I acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit. Before we begin today's webinar, I'd love to review a few housekeeping details. Please note that your microphones have been muted to avoid background noise as you've joined. And we've allocated ample time for questions, which we'll be taking through the chat function, which is that little bubble on the bottom right-hand corner of the screen. We will address many questions as we can during the Q&A portion of this event. This session is being recorded and will be shared on our website in the past events pages. And finally, when leaving the event today, a survey prompt will appear. Your feedback is very important to us, and we encourage you to complete our very short survey to inform future events like this one. And now I'd like to introduce our moderator for today's session, Jason Stewart, an executive in residence at the Global Risk Institute. Jason, over to you.
Thanks, Vanda. Good morning and welcome. Today's session is the second in GRI's 2023 Macroeconomic webinar series. This series aims to help our members understand fiscal and monetary policy during the pandemic, looking at their expected evolution in 2023 and beyond, with a focus on the financial market risks along with other impacts. We will begin today with a presentation and remarks from Bill White. We will then move to the Q&A component with Bill that I will moderate. I'm now pleased to introduce our distinguished speaker, Bill White. It's a pleasure to introduce Bill given his distinguished career in Canada and internationally. Bill is a senior fellow at the C.D. Howe Institute and a former deputy governor at the Bank of Canada. His extensive international roles include being the economic advisor and executive committee member at the Bank for International Settlements, or BIS. Bill's path-breaking analysis has regularly highlighted risks too little recognized by financial markets. In 2006, he identified the crucial risk, well before the great financial crisis, of why achieving price stability may not be enough to avoid serious macroeconomic shocks. In 2012, he highlighted the risks of sustained ultra-low interest rates, given the unintended consequences of weaker long-term economic growth, investors taking undue risk, and major misallocations of capital. And in his GRI webinar last March, Bill accurately noted the risk of the Fed and other central banks needing much higher rate increases than markets and policymakers expected in early 2022 to rein in inflation. With those comments, welcome, Bill, and please begin your remarks.
Thank you very much, Jason. Let me start off by thanking both you and GRI for the invitation to come and speak. To be invited back to speak is always a special pleasure because it indicates that you found some value in what I had to say last time. You've already alluded to the fact that I have a rather dark view of the world. And of course, if you've been looking at the newspapers or the markets in the course of the last few days and weeks, everybody seems to be lightening up. You know, the IMF is revising up its forecasts. I'm going to continue with my rather darker view of things. And I would point out that when you think about some of the official forecasts, for example, the IMF in 2008 forecast, I think, 3.5% real growth for the advanced market economies in 2009, and the actual outturn was something like minus 3.5. So I think there's plenty of room, in spite of the current optimism. There's plenty of room for divergent views. Let me start off with a brief overview of what I'm going to talk about. Um, uh, Basically, I'm following up on the title actually, which GRI asked me to talk about, the new macroeconomic paradigm, the lessons, and then the policy needs. What I'm going to start off talking about, this new macroeconomic paradigm, I think we're going from a world of plenty to a world of shortages. What that means is that there will be a tendency for both inflation to be longer lasting and for interest rates to be higher than perhaps people currently anticipate. The second thing, the pandemic lessons. Past macro stimulus now constrains policy options. I think that one of the lessons we should take away from the pandemic is that macro stimulus can be used to excess. And one of the lessons we learned from the pandemic period is that excessive stimulus can contribute to inflation. I'm hoping, and I'll go back to this in a few minutes, that there's other lessons of a similar nature that can be learned. Not least that excessive monetary stimulus can create private debt problems that come back to haunt you, and that fiscal stimulus can raise the stock of sovereign debt in a way that can come back to haunt you. As to the policy needs, we have a world in which I'm contending that aggregate supply is going to be constrained, but that demand pressures will continue. And obviously, what that leads to is the only way to square the circle is that something's got to give. And I guess what I'm going to contend later on is it might well be consumption. And that's not going to be an easy thing to sell. And all of this comes with high stakes. That's my last slide, because these economic difficulties are going to threaten some other systems that are already subject to their own fragilities: environment, health, and perhaps even the political system. Let me talk about the macro side, and about moving from an era of plenty to an era of shortages. Sorry, have I gone too far? I think I have. There we go. Yeah, let me start with a few words about sort of where we are, how we've gotten to the situation of inflation being where it is. First point is obvious: supply shocks, which is the pandemic and the Russian invasion, obviously contributed to peak inflation. I'm not denying that. Those influences are now fading away. At least the short-term impact of them is fading away. And that's what's giving people some optimism that inflation is coming down. I would also note, however, that it was not just supply side shocks, that excess macro stimulus also contributed to the excess of demand and the resulting inflation. And there's all sorts of people, representatives of the Fed, the ECB, the Reserve Bank of Australia, I think even the Bank of Canada, who have all admitted to that. So there we are. The central banks found themselves behind the curve. Now they've tightened belatedly and aggressively, and inflation is declining. And I guess that's the good news. The question, the next bullet, is it enough to hit the 2% inflation targets? We know inflation is coming down, but is it coming down enough to meet those targets in a timely way? And on that, there exists at the moment an enormous range of views. I mean, there's a number of people, I guess, including the Fed, who would say that the past tightening, what they've already done, plus what they're likely to do, the 50 basis points the next time, will be enough to cause inflation to hit the targets. Everybody's a bit ambiguous about will that take a recession? Is a recession already in the works? Will it take a recession or not? Well, one school of thought that says we have done enough, more or less. But there is another school of thought, and I think I'm part of that, is that saying what we've done is not going to be sufficient. and that the terminal rate for the Fed, 5.5%, it might actually be higher than that. And the same thing in Europe. And I think the distinction between the two is that the people who say we've done enough basically say real wages have taken a hit and the workers will eat it. And the other group is basically saying, and Olivier Blanchard just published something here just a few days ago about this, is that no, we've had a big reduction in real wages in many, many countries. The workers will not accept it. There will be an increase in wages in order to try to redress wage price spiral. Still more tightening will be needed. So that's really the difference between the two. And I would note, and this is a very recent thing, that the reopening of China is going to pose further inflationary risks. Now, on the one hand, it's clear that there will be a big increase in the demand for commodities and for other inputs. On the other hand, the supply lines coming out of China might reopen in a way that will increase supply so there's a bit of a wash with China, but it certainly is a risk going forward that the inflationary pressures will be stronger than some expect. Now, what I've gone through really up till now is how past events have got us to where we are. But let's talk a little bit now about the future, about going from an era of plenty to an era of shortages. The first bullet, supply shocks from the past. Although I've said that the short-term effects of the lockdown and the breakdown of the supply chains is sort of gone. Okay, we're past that. There are longer-term historytic effects that are still going to remain. And I mean, one of them in terms of labor markets, long COVID, people who are finding it mentally difficult to sort of come back to work. The change in supply chains, going to be much more sort of emphasis now on resilience, okay, to avoid some of the problems that we had in the past. So this is all coming, longer term implications of COVID and the Russian invasion. Malinvestments. I just mentioned the fact that we have had, and I'll come back to this, a long period of easy money that I think has led to a lot of capital being wasted, resource misallocations, or in Hayek's terms, malinvestments. And so that some of the potential that we see being associated with current levels of capital, in fact, that potential is not really there because that capital will never actually produce anything. So we got some of these lingering supply shocks from the past. I think what's underestimated is some of the supply shocks that are coming down the road in the future. Second bullet. First one is the question of demographics. Okay, Charles Goodhart's an old friend of mine, wrote a whole book on this with his colleague Pradhan, which is called The Great Demographic Reversal. Just a few days ago, we saw that the Chinese population, for the first time since records were kept, has gone down. The number of workers has been declining for quite some period of time, even more in Korea and Japan. Also, the baby boomers have gone through in the Western countries. So we're going to have a continuing problem with workers going forward. Climate change is another thing that I don't think is being factored enough into the economic calculations. Whether you're talking in terms of mitigation, locked in fossil fuels, whether you're talking in terms of adaptation, you know, there's going to be a lot of destruction associated with climate change going forward. That's going to be a big problem. On the commodities front, you remember that commodity prices went up very significantly even before the Russian invasion. And when you look at them independently, energy, we have a continuing problem. Food, we have a continuing problem. And I think above all, metals Okay, we're supposed to be moving into a green new world, but it's not a fossil fuel driven world, it's a metal driven world. Whether it's for batteries, EVs, transmission lines, that's going to be a continuing problem. The global supply chain restructuring aggravated by geopolitics. I was at a meeting a few weeks ago now, of the US-Canada Commission on China, and talking about all of the legislation that's going through in the United States to try to decouple. There was a lot of feedback from the economists at that meeting about the costs of the decoupling, because the Chinese, of course, and the Western economies are now linked like this, and restructuring away from China in particular, even if it's just other emerging markets, is going to be very costly. There's a need for huge capital investment to cope with future supply shocks. So, we sometimes think about a supply shock as being sort of naturally, there's a negative feedback effect, because what you do spend on higher energy, you can't spend on other things. But this is different going forward, because when you think about the shocks that we're confronted with, there's going to be huge amounts of new investment to cope with climate change. Charles Goodhart points out that in his book, that if there are fewer workers, then we're going to have need for more capital investment in order to replace them and to continue production. And a lot of this spending is going to come through government spending. And then you add on the military buildups and the geopolitics and all of this. And I think what you do come to is that this could well be a recipe for higher inflation and higher real rates. So we have a problem here. Real rates should go up. But the point of the matter is, it's the central banks that are in the middle controlling the nominal rates. And I think there's a lot of reasons why the central banks might be quite concerned about allowing nominal rates to move up as much as this real interest rate movement might require. So we have a problem. The first one, and I'll move along a bit more quickly now, has to do with financial instability. We have had, and I've said this before, we've had decades and decades of ultra easy monetary policy. Whenever there's been a problem, the answer has been to reduce the interest rates or to otherwise stimulate forward guidance, QE, all that stuff. And that has produced a lot of side effects that I think are really contributing to the prospects of financial instability. One of them is we have record high debt levels. When you look at the numbers from whoever, what you see is that the ratio of debt to G&E virtually everywhere, both the private sector and the public sector, is at record highs. We have asset prices, which, as we all know, have been falling over the course of the last year, but some of them have not been falling, and many of them are still very high using traditional metrics. And the McKinsey Global Institute recently published a piece that was really fascinating, pointing out that if you measure all of the assets that we think we own, both the financial and the real assets, only 7% of them are actually things that really produce stuff. Okay, like infrastructure, investment, intangible investment, 7%. So you've got a huge fulcrum of all of these assets, measured assets, on a very, very small base. Stability of some financial institutions, I think, is questionable. The banks, on the one hand, we say have got higher capital levels. There was a recent article in the FT by Tom Hoenig, used to be the president of the Federal Reserve Bank of Kansas City, who basically says, not so fast, we're actually back to where we were before the crisis. When you start thinking about insurance companies, pension funds, so many other financial institutions, particularly the non-bank financial institutions, where they're not well regulated, they're non-transparent. We simply don't know whether they're stable or whether they're exposed or whether they're not exposed. And the next two bullets, markets. Markets have been functioning very badly over the course of the last decade, if not longer. All sorts of flash crashes, where the movements are well outside the range of what a normal distribution would say. Anomalies that normally arbitrage would close in, and it's not happening. So there's some underlying issues out there. And then I note that even the US Treasuries are under stress. And if the US Treasuries are under stress, everything's under stress, because everything in a certain way is linked back to the markets. And this last bullet, systemic interactions more evident in light of the gilt debacle. Now, for those of you not familiar with it, they brought down a budget in the United Kingdom, the so-called under Prime Minister Truss. It was totally imprudent. It caused gilt rates to rocket. And what happened in consequence, and this is the point, is that the margin calls on the leveraged derivatives that many pension funds were holding led them to sell gilts in order to get the money to meet the margin requirements. And that just made the initial increase in gilt rates worse. And the Bank of England had to step in to try to do something about it. So financial instability is a real issue. The next one, and this is more recent, this is fiscal instability. As with interest rates, which have been ratcheting down basically for decades, government debt levels have been ratcheting up for decades. And it hasn't been so much that governments have used active discretionary fiscal policy, but the point is that the implications of the automatic stabilizers on the downside have never been matched by the implications on the upside. So that the deficits get big in the recessions, but the surpluses never match them in the recoveries. And so the upshot is that the debt stocks just keep going up and up and up. And most recently, of course, if that's sort of the broader history, more recently, we've had extraordinary increases in government debt ratios in response to the COVID and the energy price shocks. Now, these higher interest rates that we're seeing more recently are sort of icing on the cake, because what they're doing, of course, is they're going to increase debt service requirements. And it's not just what you might normally expect as the interest rates go up against the backdrop of that stock of debt, because QE basically involves swapping long debt for short debt, overnight money, okay, at the central bank, okay, the shortest government debt there is. And so we're starting to see debt service being affected by higher interest rates much faster than we might have thought. And there's an optic that goes with it that I don't much like, which is that this QE, the increase in central bank balance sheets, has been just about the magnitude of the increase in the stock of government debt, leaving the idea that printing the money for the government is the way it's going to be, which is not a good optic. And another thing that's not a good optic is that QE, where central banks have bought in all this long-term debt, QE is resulting in them actually beginning to show meaningful operational losses. And beyond that, even bigger losses when you think about market value. And so the Fed, for example, at the moment is over $1 trillion underwater. The Swiss National Bank has just announced a loss in 2022. It's equivalent to 18% of Swiss GDP. So these are optics, but the question is whether they're more than optics. So let me go on to the next one. The last one, and I'll go through this very quickly, exchange rate instability. This really doesn't have to do with the Fed sort of backing off interest rate increases. It's where everybody else finds themselves. So we had easy money at the beginning of the great financial crisis. It led to a lower dollar. And you may remember the famous accusation by the Brazilian finance minister of currency wars. So as the US dollar was going down, other currencies were going up. But basically, people were worried in those other countries about appreciation and the loss of competitiveness, trade competitiveness. And they said, we don't want to do that. So they leaned against it. The advanced market economies mostly did it by having as easy monetary policies elsewhere as you had in the United States. And the emerging market countries did it mostly through foreign exchange intervention. But in both cases, it wound up to an easing of monetary policy. So in effect, what you had, because of the concern to maintain exchange rate stability, all of these problems that were building up, particularly in the United States and the English-speaking countries, then sort of got translated to becoming problems really all around the world. And so that's a problem. And I mean, just as some examples, Japanese government debt is now 250% of GDP. UK government, this just came out in the FT this morning. UK government borrowing in December was 27 billion pounds, twice November, and 3 times the level in 2021. So this is mounting up very quickly. 60% of all low-income countries are either in or near debt distress, according to the IMF. So as the phrase goes, Houston, we have a problem. So where are we? The hard choices. If we do have these continuing negative supply shocks associated with increased demand for investment, in particular, we need to tighten macro policy. But as I've been stressing through this whole presentation, tighter monetary policy could create instabilities of various sorts. And I think the way that that would work, frankly, is that first of all, the higher rates would cause financial instability, which would probably lead to deflation or something like it. The monetary authorities or the governments then step in, but they themselves already have fiscal problems, sovereign debt problems, and that would lead still further down the line to much higher inflation. So that's sort of the prospects if we do nothing. What to do? I think this is what the politicians or the political scientists would call the best way out, is orderly debt restructuring. Could reduce the private sector debt problem and perhaps even the public debt sector problem. I think fiscal restraint will also be needed on a continuing basis. Now, what that means, if public spending has to rise and if investment overall has to rise against a backdrop of constrained supply, the only way to square that circle is to cut private consumption, or at least to cut its expected rate of increase. And that is going to be extremely hard to sell politically. And this is my last slide. Sadly, even in the face of hard choices, you still have the lure of easy options. And the easy option is to print the money, to continue doing what we're doing at the moment. Now, my first bullet here, all of the people that you have to convince to do hard things are going to be very hard to convince. The citizens, when you start saying things like your rate of growth of consumption must be lowered, instinctively are not going to like it and are going to look for an easier answer. The powerful, when you say to them that you're going to have to give up some of that power to present a more equitable kind of inclusive future, are not going to like it. And the politicians are also going to find it very hard to stomach. So one possibility is denial, and I think that's not unlikely. Just continue to do what we have been doing. As I've stressed, however, that leads you down some very bad paths, because real interest rates will in the end have to go up, and that will lead to the kind of processes I've just described. So the question is, what might people try to do about it? One possibility, and I'm hearing this more and more from people that I actually really respect, is that we'll try the out will be financial repression. What that means is you let the inflation rise somewhat, but you keep the interest rates down, either through regulatory means or through yield curve control, whatever. So that you have a period of time where the rate of growth of nominal income significantly exceeds the interest rate. The debt overhang gradually goes away, and then it's back to business. And this worked after World War II. That was the way they got out of the debt problem then. Significant inflation for a number of years, repressed interest rates. The real question is whether it could work in the modern society, and I'm not so sure. And I finish by saying we've got to get this right, because if we don't, we've got all of these other stressed systems that are not going to get the kind of attention that they need. And what that implies is problems environmentally, politically, with respect to public health. So the stakes are really very high indeed. We either have to choose the best way out, or we have to make financial repression work, because otherwise the outlook will be significantly gloomier. Jason.
Thank you, Bill. We'll now turn to the Q&A. Reminder, if anyone in the audience has a question, we invite you to type it into the chat box on the bottom right of the screen to all panelists. And for our first question, we'll start with, given 15 years of unconventional monetary policy approaches that began with the Great Financial Crisis and increased during the pandemic, what lessons do you draw regarding the future use of forward guidance and quantitative easing for the Fed and other central banks?
Yeah, well, that's a good question. As you can see, I'm sort of pretty skeptical about the end results of many of the monetary policy procedures that we've been following. On the forward guidance, I think the first thing that we've learned is not very useful because events often make the guidance unreliable. And this goes back, there were a number of occasions in the UK, also in the United States, where you had the guidance, and then of course I had to change the view because the reality changed. Something closely associated with that, of course, is that every time you do that, you say, I gave you guidance, but it's not happening, you lose a bit of reputation. You know, there's some reputational risk associated with each time you do that, which is not good. And the last thing, and I think this is the worst thing of all, and I think this may have played in, some people say it played into the way the Fed didn't react quickly enough to the rising inflation in 2020 and 21, is that they were held back from raising interest rates because they'd given forward guidance that the rates wouldn't rise. Do you follow me? So in a sense, having the forward guidance in the end might well have proved to be sort of, what's the word, counterproductive. And on the QE, honest to goodness, the thing was never thought through properly, right? Ben Bernanke himself said, we think it works in practice, but we don't know how it works in theory. And when you think about QE, you're talking about raising reserves. That's got implications. You're talking about cutting the amount of bonds outstanding. That's got implications. Cutting collateral available for deals. That's got implications. And then lastly, the signals, risk on, risk off. That's got implications. How does that all play out? And the answer is nobody ever thought it through properly. Then when you think about the implications for the government deficit, I don't think that one was thought through properly either. As I said just a few moments ago, you got QE. It involves buying in long government debt and paying for it with central bank reserves. Then when the interest rates go up and you have to pay interest on the reserves, the central bank starts losing money, i.e. the government starts losing money. And that now amounts to huge, huge sums of money. And even the sort of the solvency of the central bank is being questioned. So it's also very hard to resist, to reverse. There's a paper recently by Viral Acharya and Raghu Rajan, and basically they say the banks were given all this excess liquidity. And bankers being bankers, they didn't want to just sit on it. They said, let's put it to work. Well, the way you put it to work is by renting it out to people and by increasing, credit lines and things of that nature. And so now the demand for excess reserves are going way up. So when you try to take it out, well, the demand is still there. You shouldn't be surprised if you're going to exacerbate problems of market liquidity that are already sufficient to cause the big problems we saw in September of 2019 and March of 2020. So for people who say we've now got permanent new additions to the toolbox, I guess my reaction is think again. I'm not so sure.
Thanks. Broad-ranging and very helpful response, Bill. Second question. Among the challenges that you've written about for central banks are the serious problems that macroeconomic models had in predicting growth and inflation during the GFC, the decade after, and then during the pandemic. What advice would you offer to improve these models' accuracy and to enhance their use in setting policy in 2023 and beyond?
Well, I guess my view is that the standard macro models, whether they be the big structural models or whether they be the DGSE kind of models that have come into common use really in the last 20 years or so, I don't have much, if any, faith in any of them. I started off by noting that the IMF and the OECD and the rest of them all totally missed the beginnings of the great financial crisis. What I didn't mention was that they also missed what would happen to inflation and what would happen to real output subsequently. Like we had 9 or 10 years in a row of inflation being over-predicted and real growth being over-predicted. And if it had been me, I would have gone back to ask, is there something wrong with the basic analytical framework that I'm using to generate these forecasts? But that didn't happen. And now I think it should happen. These models, I mean, when you look at the characteristics of them against the reality of the way the economy is, they are based on so many assumptions that are totally unrealistic. You shouldn't be at all surprised that they don't work. So I actually was, I was a panelist introducing and concluding a meeting of what is called the Better Policy Project, which was organized by an old colleague of mine, Doug Laxton, and involved 75 central banks, model builders at central banks. And they themselves are showing an increasing willingness to start thinking about different ways to do it. And the one thing that I think is clear is that aside from making forecasts, and forecasts are frankly impossible in a complex adaptive world, instead of making forecasts, what people really should be doing is telling plausible alternative stories, laying out scenarios. and sort of saying, if this were to happen, if this bad thing were to happen, then we would be prepared for it in the following ways. If an alternative bad thing were to happen, well, we'd be prepared for it in the following kind of ways. And that's really the way in which policy ought to be conducted going forward. So I don't. The current models, some of them might be salvageable, but personally, I'm pretty doubtful.
Thank you. Picking up on some of the questions from the audience, and I apologize in advance, we will not be able to get to all the questions from the attendees. Starting with your comments on reputational risk and the challenges in that regard for credibility. First question, do you think central banks are going somewhat soft on their inflation targets, given the challenges and the very narrow path that you outlined to success?
As I said in the presentation, there are widely differing views about how things will work out. Some people think that what's been done to date, plus what's forecast for the next few months, terminal rates of 5.5% in the States, 3.5% in Europe. A lot of people think that's sufficient. My own personal view is that I doubt it, and not just because I think the wage price thing may take on a certain dynamic like Olivier Blanchard is talking about, but I think these longer run problems that will cause for, that policy might not be higher, but it might be longer, the tightening. I think that's what's likely to happen. So I wouldn't say that the central banks are being too soft so much as I think perhaps they're underestimating the difficulties that they will have. And when they do observe those difficulties, then the question becomes, will they respond as I suggest they should, both they and the governments? Because now it's become, the physical thing is of such a nature that I think monetary policy, tighter monetary policy, in fact, may have outlived its usefulness. There's quite a literature on this, going back, to the famous Sargent and Wallace paper in 1982, where they talk about some unpleasant monetarist arithmetic, that if you get enough of a problem on the fiscal side, as you start to tighten up monetary policy, it adds to the debt service in an unsustainable way and actually contributes to unsticking inflationary expectations as opposed to making them stickier still. So if you get into that situation, and I think we're sort of getting close to it, that the real action ought to be on the fiscal side as opposed to the monetary side.
Picking up on that last comment, Bill, one of the questions looks at the reality that we can't rewrite the history of stimulus packages, but what are the lessons that you see in terms of learning how to support vulnerable populations financially, the system generally, without crashing the system and vice versa?
Well, one, we're going to have big demands on the economy as a whole. As I said, with sort of supply constrained in various ways, I think, and demand increasing, particularly for investments, climate change, shortage of workers. But in addition, there will be a needed concern to support the most vulnerable in society. And that's going to put a lot of strains on both the economy and the government in particular. And I think in terms of protecting the vulnerable, for a starter, in terms of government expenditures, there should be an awful lot more care in targeting those that receive government benefits. That blanket handouts is not the way to go when you've only got scarce resources. And I mean, I can remember 30 years ago when they cut off the family allowances, my saying as the Deputy Governor of the Bank of Canada, I agree with that. As Deputy Governor of the Bank of Canada, I don't need this universal support. So I think we need much more of that. But I think in addition, people should be thinking about where the resources might come from. And there'll have to be a lot more thought about higher taxes for energy, for property, other stuff that governments sort of more or less provide at less than their full benefit. So more targeting, and I fear the minute you start talking about the more vulnerable, then it is the less vulnerable that will have to pay for it, and some way will have to be found to do that. And I think that in a humane society, I think that's part of that is coming down the road, and we're going to have to learn to live with it.
Switching to some of the other comments, one of the questions from the audience relates to your view of where the economy is now, particularly Canada versus the US, and secondly, your view of whether the Federal Reserve is going to have a higher terminal rate than the Bank of Canada this year.
Yeah. Well, in terms of the respective sort of cyclical positions, I suspect Canada may be somewhat better protected in that we've got a stronger commodity base. And I think if you buy into my story about the supply side stuff, that's likely to be helpful. It's when you start turning to sort of the underlying problems that it becomes difficult to make a judgment about who's going to suffer more or less going forward. I somehow suspect that the US financial system, being more market driven and more non-transparent, may have greater problems than the more bank-centric Canadian system, which would be helpful. On the fiscal side, I think central government stock of debt ratios are about the same in the two countries. So that argues for them being arguing for sort of similar type outcomes. The willingness of the Canadian political establishment to do the hard things if necessary may be much greater than in the United States, where the political division seems to me to be much greater. So trying to predict, well, as I said before, it's forecasting is sort of a mug's game, whether it's cyclical or secular. But I think looking forward, both countries are going to have some hard decisions to take in order to maintain both economic stability and stability in those other realms that I mentioned on my last slide.
Picking up on a couple of themes that we're seeing come across here, but your specific remarks with respect to macroprudential regulation. This was one of the major changes coming out of the great financial crisis to improve the stability of the banking sector. But given your comments about non-bank financial institutions and their risks, what changes and approaches should regulators be undertaking to address these as well as remaining banking risks from your perspective, both from the BIS, but also from the Bank of Canada?
Yeah. Well, I've sort of suggested, I mean, it's in many articles, and it's been the backdrop for my presentation today, is that I think sort of monetary policy or stimulative monetary policy has sort of outlived its usefulness. I think the regulatory side is equally suspect. And what I mean by that is the following. I see a world in which we started off with banks that were subject to runs, and the governments in various countries said that's very, very costly and we have to do something about it. So we have safety nets. And then, of course, you say safety nets. Well, that's moral hazard, right? So people will be inclined to do dumb things. So we have to offset the moral hazard with regulations. We get regulations. But the problem with regulation is that it just invites adaptation and evasion, which modern technology is increasingly encouraging. And so then you get a crisis. So then you get a run on the non-banks, okay, which is what we had in the great financial crisis, right? It started with the shadow banks. Okay, it wasn't the banks, it was the shadow banks. Then we had the pandemic, and the Fed had to extend the safety net to so previously it was just the bank holding companies. Then they had to become the market maker of or market purchaser of final resort. Okay, so the safety net got extended again. And so we're talking about a process here which has been going on forever and forever, and which can't be dealt with by still more regulation that invites still more adaptation and evasion. And my preferred solution, although it's not going to happen for all sorts of reasons, is that we go back to something closer to the narrow banking suggested by the Chicago School in the 1930s, which is you draw a clear line between stuff that is not at risk, i.e. money, essentially issued by the central bank, and everything else which is at risk. And you draw the line, and then there's no safety net, and there's no regulation. There's risky and there's non-risky, and people adapt, and then you get on with it, and it's sustainable. Now, I'm old enough to know that it may well be that there's all sorts of unintended consequences that go along with it. But I do think we should be thinking a bit more seriously about this as an alternative. And it won't happen in one country. I mean, it can't do. They actually had a referendum on this in Switzerland, you know. And I participated in some panels thinking about the implications of that. I think the Swiss rejected it on the grounds that going it alone is not a good place to be in an uncertain world. But I think the world more generally should be asking themselves whether we've gotten onto the wrong path with respect to some of these fundamental issues of financial regulation.
Bill, picking up on that theme more broadly, one of the questions from the audience, and it's nicely worded, markets appear to be pricing in immaculate disinflation, no recession, inflation back below target, and rate cuts. Have we been corrupted or unduly influenced by the prolonged period of near zero rates, and will we ever wean ourselves off easy monetary policy, to pick up on your remarks?
Yeah. Well, I think in part, the markets, I'd have to think this through a bit more carefully, but the markets can either be saying, with the bond rates in particular, sort of, you know, being lower, that they see the inflation coming. I haven't looked at this recently, sort of the expected inflation that's, you know, embedded in the term structure. But it can either be they think that that we'll get a recession that will drive the inflation down, or that we'll get an immaculate disinflation and it'll come down of its own accord. Personally, I don't see the process through which it would come down. I think, going back to the questioner's sort of premise, that after so many years of low inflation and low interest rates, that people think that's normal, and that's what we're going to go back to, and that's basically what's driving the forecast back to normal. But that doesn't always happen. I mean, I remember Larry Summers once at a presentation saying, "What comes next? 1, 2, 3?" And most of the time people say 4, because it's obvious. But then it could be 3, because the best forecaster of tomorrow is always today. Could be 2, because things go back to the mean, which is sort of where we're at the moment. Or could be 1, which I guess is my thesis in my presentation, because everything that goes around comes around. And so you could have some really very different results depending on the circumstances. So I think the markets probably do have an element of immaculate disinflation. And I think it probably comes out of the fact that we've had low inflation for a long time, and surely that's normal. But I guess my presentation tried to imply, well, we may have had it for a long while, but it doesn't mean that it's what characterizes the future.
Thank you. I want to pick up further on that with apologies to the other questions that we couldn't get to. As the final question, Bill, being more specific in terms of the near term, the Fed's and other central bank challenges include times like the current one when financial markets have a fundamentally different view than the FOMC. The Fed's made it clear that reducing inflation remains the overriding priority, and investors should not expect a rapid reduction in policy rates when the peak is reached. Yet for several months, I know the immaculate disinflation, as was talked about for the scenario, the markets have been pricing in a pause in policy rates in early 2023 and then rate cuts in the second half, not a plateau. What, in your view, should the Fed be doing and other major central banks given this situation?
Well, I think one of the things to point out is that the dot plot is really a form of forward guidance, about which I've made a few comments a few minutes ago. That it's all, to me at least, it's all sort of pretty suspect. And I guess what I would like to see is a clearer statement by all of the central banks about the analytical framework, or the numbers, as it were, that contribute to the conclusion that they have drawn. You know, that 5.5 will be enough, and run through the sort of, you know, whether it's the Phillips curve or the money supply or whatever they're using as an indicator of future inflationary pressures, to be very clear about what their assumptions are, and then try to be very clear about what other people's assumptions are. And in a way, it's going back to, again, something I said before, is that you just be laying out two scenarios. So not thinking about them as, this is my forecast and I'm right, but rather everybody looking at it from the perspective of, there are different assumptions you could make and you come to different conclusions. But what that would leave open would be the possibility for the Fed to say the circumstances have changed, 5.5 no longer seems adequate, or alternatively, we don't need to go there because inflation is coming down so quickly. But having clarity about the underlying assumptions of alternative scenarios, and being clear about your willingness to change your policy instrument depending on the circumstances, but always consistent with the achievement of the objective you wish to seek, I think that would be a step forward.
Excellent, thank you. With that last response of Bill's, we've come to the end of our time today. Once again, thank you, Bill, for joining us.